Hello, hello, hello. Good day, good day, good day, one and all. Welcome back again to Rudy Radio. This is your host, Keith Simon, from the well-known, publicly known now, Keith Simon Financial Fix. Hey guys, I'm excited this morning. As you can tell, I'm stuttering a little bit. I'm super excited because I am going to talk to you about a little known secret. It's a known secret that there's an uncle that you have that you probably don't know that you have. His last name is Sam. His first name is Uncle. Hey guys, just a play on words, but let's play on words a little bit more. It's really the something called a USA, or if you want to call it US. Uncle Sam. Uncle Sam is the U.S. taxation, as we locally if you want to say regularly, we call it, right? In the financial industry, we always talk about our favorite uncle, right? Last name Sam. Hey guys, we're going to talk today a little bit about taxation, and that's why I brought up the gentleman, Uncle Sam, right? We're going to talk and understand a little bit about capital gains tax. We're going to understand a little bit about tax now, tax later, and tax advantage. One of the things that I found out when I started this business is I realized that taxes are inevitable. We have to pay them. But how do we recoup taxes? We always say that you recoup taxes by owning your own business, being an entrepreneur, helping others, being a philanthropist, right? Helping others by donating, right? It's very, very important that we understand taxation. Every one of us. For example, there's something called capital gain tax. Almost everyone you know have to pay capital gains tax. It's either personal or whether it's personal or investment purposes. Capital assets, meaning what you have, what you own, your home, your stocks, your bonds, your car. Unfortunately, you have to pay tax on them. So these things have become so commonplace, right? That every year we know we got to pay the house tax. Every year we know, or every 2 years, we got to pay the car tax. We know these things. And of course, we know every year we have to pay our own income tax. I had a conversation the other day with a gentleman that says, oh, well, I'm on Social Security. I only make $12,000 a year, or I don't think I need to pay any taxes, so on and so on and so forth. And my response to him is wonderful. What happens if something was to happen where you have to show that you had paid taxes? And that's the only instrument, and that's the only logical thing that they will allow in order for you to gain something, or to buy something, or to sell something. What would you do? So even if you have no return, I feel, and this is you could talk to your accountants, right? Talk to your accountants, but I feel that it's such an important thing, taxation, that we want to make sure that we take care of it. All right, so let's jump into what we know as capital gains tax, or capital assets, right? The short term is gains. Anything that you gain is gets taxed by ordinary income tax, unfortunately. So the cliche is that you buy something, they tax you. Your uncle does. You sell something, your uncle wants a piece, right? So you buy something, your uncle wants a piece. They tax you. You sell something, they tax you. You put your money and you save it in the bank, they still tax you. And unfortunately, when you pass away, yes, they still tax you. So one of the things that we talk about also that is very, very vital is when doing taxation, how do you decide what and who gets taxed first, last, or in between? Well, A little known secret is yes, you, my listening audience, yes, you, my non-listening audience, right? Um, and if you're a non-listening audience, you better become a listening audience because this is vital stuff, right? Just a little joke there, but really and truly, we have the tools, and the tools are laid out for us very simply. If you're gonna get taxed now, it's simple. They tell you exactly where to put your money so that you're gonna get taxed today. Your uncle does. U.S. If you're gonna get taxed later, they literally tell you where to put your money where you're gonna get taxed later. How about tax advantage? If you want to gain tax advantage, they also literally lay out all the ground rules where you put your money. So there's only three places that we can put our money in these United States that will qualify us: tax now, tax later, and tax advantage. Where do you have your money? It's a vital question. A lot of times we say, hey, I don't know if my money is getting taxed now. Well, that's why I'm here. That's why Keith Simon Financial Fix is here. Because we want to fix your mind and let you know, educate you to let you know where you have your money. Because also often I hear, I didn't know, I didn't know, I didn't know. So let's talk about the first one, which is major. Tax now. Your checking account in the bank. Tax now. Your savings account in the bank. Tax now. CDs, your stock, mutual funds. Tax now. A lot of us know about stocks and bonds are getting taxed now. But when I tell you your checking account is getting taxed now, most people say no, never happened. I didn't see that. So my response is, did you get a 1099 at the end of the year that says 15 cents, 20 cents, 30 cents, 40 cents? And most often the answer is, oh yeah, I did see something like that. Well, guess what? That's your tax. That's your tax. It just so happened that the interest rate is so low on your checking and savings account that your tax is minimal. But the bank has to let the federal government know that they have sent this out so that you get taxed, because the bank is not going to pay it for you. That is tax now. The current climate that we're in, a lot of people are saying stock. Everybody wants to jump into stocks. Everybody wants the Robinhood app. Everybody wants the bitcoins and so forth. Hey guys, capital gains tax is no joke, right? So you buy a stock, wonderful. You sell a stock, or you make gains on a stock. It's all taxable. All of your gains are taxable. And go look it up. Don't take my word for it. We're looking at about 15% on your gains. So how long do you have before you can take your money, before you get that capital gains tax on your stock? I have a gentleman that I'm working with now, older gentleman. He's about 72. Very, very savvy gentleman. Has maybe about 400 shares of Apple. And guess what? He says, Keith, I'm gonna take my money and run. I said, where are you running to? Right? It's a joke, a joke that we have. I said, where are you running to? And then I say to him, that's a running joke, because you can't run from your uncle. No matter what state that you go to, you cannot run. Right? You have to pay the taxes. So every time we have that conversation, he picks up the phone and he said to me, I'm thinking about selling stocks. I said, okay, but remember, you got to pay the taxes. And then he hangs up and says, well, maybe I may. Before he hang up, he said, well, I'll think about it. So he's always thinking about it, have not sold anything yet, right? So this is maybe about 6 to 8 months now that he's been saying that, right? And then you have your mutual funds. And your mutual funds are just that simple as well. Everyone getting together mutually to have fun. It's the cliche, right? So you pool all your funds together, right? You have 5, 6, 10, 15, 25, 300, 3,000 people pooling all their funds together and hoping that once the market grows, everyone gets a penny, $2, $3, and it gets an equal share. And once they get their equal share, you also pay your equal share of taxes. Now. So that's tax now. One of the things that is so important about tax now is when I talk to people is that having your money in the bank. Let's go back to the bank on the checking and savings account for a second. Having your money in the bank and paying taxes. Everyone says, no, I don't like it. I don't like it. The bank always, the bank takes our money and they invest it and they do what they need to do with it, and we end up paying the taxes on it anyway. So what I say to that is, if the bank is a quote unquote money shop, then that's what a shop is supposed to do. It's to gain interest and use whatever the resources they have. In this case, the resources or the product is money. So don't complain or try not to, right? What you do instead is that you find alternative ways where you can put your money. So the second bracket is tax later. And hey guys, feel free to get in touch with me so we can explain that tax now a little bit more. But let's talk about tax later. Tax later was described to me very vividly, and I was very annoyed, and I use this constantly with my clients. If I give you $100,000 after about 6 months, I say to you, hey, this is a contract that we're drafting up for 6 months. I'm giving you $100,000. I want my money back. I will not tell you how much interest I want on my money until that 6 months is up and it's time to pay. I also don't know what the tax implications are. Your uncle, right? Uncle Sam. I don't know what the tax implications are. I don't know how much he's going to charge you. That's your problem. But I know what I want. I want my $100,000 plus interest. I will let you know what the interest is come 6 months from now. Would you take that loan? Would you take my money? Hey guys, I already know your answer, right? You guys are savvy enough, and I've heard from me enough to know that no, you don't take that money, right? Why? For several reasons. And the obvious reasons are, you don't know what you're going to pay back on interest and fees. Hey guys, you're listening to Keith Simon, Keith Financial Fix. This is Rudy Radio. We'll be right back.
You love chocolate.
Chocolate.
You love M&Ms.
Oh, yes.
But your tastes have grown up, and you're just not wild about super sweet milk chocolate, so you've been avoiding M&Ms.
Yeah.
Well, fear no more.
Huh?
M&M's Dark Chocolate to the rescue.
My heroes.
M&M's Dark Chocolate Candies. Available wherever fine candies are sold.
Next month, I'll be hosting my 7-day Bold Fit and Fabulous Masterclass. There, I'll be sharing tips and strategies that will allow you to begin taking the steps that you need to feel and look both fit and fabulous in and out of the office. Are you ready to reclaim your time? Then visit me at thefitterwoman.com and let's get back to the business of you.
Hey guys, welcome back. This is Keith Simon with Keith Financial Fix, and you're listening to Rudy Radio. This is Keith Simon on Rudy Radio with Keith Financial Fix. We're talking about taxation. Let's rewind a little bit. We just talked about tax now and the implementation of capital gains tax and how much your checking account is taxed now and your savings account is taxed now, your CDs, your stocks, your mutual funds are taxed now, today. But there are other places that you can put your money. Tax later. I just gave you an example of tax later. Do you want to put your money in tax later? Well, guys, if I was to give you $100,000 and that $100,000, I want that return free and clear back to me with interest. And whatever taxation that Uncle Sam is going to charge you, you have to pay it. None of my business, as they say. Let me tell you, your 401k, your 403b, that is exactly what is happening right now to you. I don't take fun of saying this, but it's unfortunately true. So doctors, nurses especially, that work so hard, frontline workers that are in the hospitals that have your 403Bs, your 401k workers, construction workers that are working so hard. I tell you guys, last year over the pandemic, I moved a lot of money, saved a lot of people heartache. I had one young lady that was referred to me after she had lost $30,000. This young lady worked day and night. She's a nurse. When I tell you day and night, she's still not even 50 years old as yet, and she had over $200,000 in her 403B for retirement. How would you feel if you wake up one morning and you had that kind of money, knowing that you're going to and preparing to live a wonderful life? 30,000 just went away. Well, guys, let me tell you, I had another young lady, another nurse, that called me, and when I explained what is happening to her, she said, Keith, all I need to know is if you can tell me, if you're this smart, if you're this genius, if you're this financial person who is also so caring, I want you to tell me, where did that money go? And just like you hear me kind of pause now, it's exactly what I did when she asked me that question. Because you know what the truth of that question is? The first answer was, I don't know. The second answer was, it went back into the stock market. But the third answer, and most important answer, which is the truth, is that it went to the wealthy. Most people don't want to hear that, but it's the truth. Where did it go? You see, understanding this industry, but more importantly, understanding how money works, is so vital. So vital. So when the market went down, most investors did what? Pull out. What they're pulling, unfortunately, becomes your money that they're pulling. Now, do they know that it's your money that they're pulling? No. No. Should they feel bad about it? No. Because the reality is, you have put your money in a place where they clearly say to you, it's at risk for gain and it's at risk for loss. So where is your money? Where is your money? Where are you putting your money? Annuities, pension. How many people lost several thousands in their pension? I know several people who have pensions and have lost as well. But hey guys, this is nothing new. It's a cyclical cycle of our system. It's a cyclical cycle of our system, and this is why it's so important to have financial knowledge. We have to know. Let's talk about tax advantage. So we talk about tax now. We talk about tax later. Now let's talk about tax advantage. Your Roth IRA. So everyone says, hey, I am not putting my money in the stock market anymore. I'm opening a Roth. How much money can you put into your Roth every year? $6,000. If you put $6,000 in a Roth IRA from age 25 to age 65, would you have enough to retire on? I'm sure you will. But are you disciplined enough to do so? Because if you decide to take some of that money in your Roth based on life throwing you a curveball, what happens? If you're younger than 59 and a half, you're gonna get taxed on your own money. Yes. I have a young lady I'm working with now. She says, oh my goodness, she's just turning 30, I believe, next week. She says, oh my goodness, I maxed out my Roth last year, 6,000, and this year, 6,000. I said, how much do you make? Oh, I make about 5,000 to 7,000 a month. So in 1 month, you max out your Roth IRA. So we're doing some strategies where we can show her how to do things differently with tax advantage. How about your college planning, college preparation, college saving, 529 fund? It's another one that your interest gain on this fund, if it's not enough, then guess what? By the way, you can choose different states that you can shop around and find the highest interest rate for your money. But guys, the backdrop to that, unfortunately, is that if you don't use it for college funds, you may use it for maybe a first-time home buyer. Outside of that, financial hardship, and it has to be real financial hardship. If not, all of that money that you may have put in there to take care of your child for his college gets taxed. And it's reportable. Let's say you make $80,000 a year and then you have another $20,000 for your twins in that college plan. That's an additional $20,000 that they will consider to be money of income if you have to take it. Yeah. So the advantage is you don't pay taxes once you put that money in, and you don't pay taxes on the gain if the child is going to college. Now, one specific and most important thing about tax advantage is that you already paid your tax when you got your check from your employer. So therefore, your tax advantage is money that you paid Uncle Sam on already. Hey guys, this is exciting stuff. We're going to take another break. You're listening to Keith Simon and Keith's Financial Fix on Rudy Radio.
Years ago, the family doctor was someone who came to your home. And while that practice has faded into memory, there is someone who keeps the tradition of personal health care alive. Your local Health Mart pharmacist knows you by name, not by refill number. Stop by your independently owned Health Mart pharmacy and see how the tradition of personal health care lives on. Visit healthmart.com for the location near you. Health Mart, caring for you and about you.
This is what your business sounds like without Audible Reach. This is what your business sounds like with Audible Reach. Audible Reach sounds like you mean business.
All right, welcome back again. You're listening to Rudy Radio, and this is Keith Simon with Keith Financial Fix. Let's bring this thing let's bring this thing home, guys. Tax now. Checking, savings, CDs, stock, mutual funds. Tax later. Your 401k. The incentive is to your boss, not to you. Your 403b, the incentives from the federal government is to your boss, not to you. So you're getting, unfortunately, your money is in the stock market and it's going up and down. There's some other ones, annuities, IRAs, pensions, and so on that are also taxed later. There's the IRAs for the business owner, SEP IRA, Simple IRA for the business owner. But we're talking about tax advantage. So we talk about the Roth IRA and we talk about the 529 plan. Mutual bonds is also one of those tax advantage. Mutual bonds, of course, is municipal bonds, right? Municipal bonds, which is government-backed bonds, they're also tax advantage. We don't see a lot of those, a lot of people investing in those anymore, unfortunately, because the market has a place for it, and some people really, truly still do. It takes a long while for that to grow. However, there is also the health savings account, locally known as the HSA, Health Savings Account. That's the account that your boss will set up or your employer will set up for you in the event that you need some glasses, right? And they may be a little bit expensive. Or you need dental work and maybe a little bit expensive, right? Or you're a cancer survivor and you're always needing some cash on hand. So what they would do is that they would allow you to save this money in the event that you need health care. And then, of course, there is something called life insurance. There's also something called long-term care. Now, you can buy standalone long-term care, and modern day now you can buy life insurance with long-term care if you qualify. So life insurance is one of those things that are tax advantage. Why? When you pass away, when you pay for life insurance, let's say $100,000, when you pass away, the beneficiary gets that life insurance policy free and clear of any taxation. It's one of the most powerful tools that the wealthy uses today. So get to understand it, get to learn it, get to know it. It's one of the wealthy's favorite tools to use. However, it's also one of the industry's favorite tools to use. One of the biggest insurers in this country is the well-known secret. It's a company called Bank of America. Hear me, I said it's a company called Bank of America. So it's a bank, right? Notice I didn't say a bank, a company called Bank of America, where most of their employees are insured once they walk through the door. Now, of course, once they walk out the door, like much employers, most employers, most of them do not have what? They do not have any more insurance. Life insurance, that is. So guys, their life insurance that are term, group term, and of course there is also something called cash value insurance or permanent insurance. Most of us know about one type, which is whole life, but there's universal life, there's index universal life. There are variable universal life policies out there as well that are tax advantage. So in the interest of time, we won't break down, we'll break this down another time when it comes to insurance itself, when it comes to that tax advantage. But tonight, I wanted to, it's night somewhere for some and it's daylight somewhere for others, and then it's morning somewhere for some others as well. So I want to make it very clear that there's only 3 buckets that we can put our money in these United States. Your money is either going to get taxed now, meaning tax today as you put it in, tax later, meaning as you retire, or when you take that money when it matures. And if it's not matured, you get taxed, unfortunately, twice. In most cases, the 401k, 403b, if you're younger than 59 and a half. I cannot stress that enough. And then, of course, there is tax advantage. And there is, of course, the Roth IRA, 529 plan, the mutual bonds, health savings accounts, and of course, life insurance. And long-term care, some standalone long-term care and some long-term care with life insurance. You see what is happening to life insurance now? You have things like terminal illness, critical and chronic illness riders that are attached to life insurance that makes it even more valuable. But the main thing about that life insurance, for example, is your long-term care. If you have it attached to that life insurance policy, you don't get taxed when you take that money. Your loan from a life insurance policy is not taxed. Your withdrawals from a life insurance policy, if you do it the right way, is also not taxed. And of course, you already know that your death benefit is not taxed. So you have your living benefit, your chronic illness, your critical illness that is not taxed. And then, of course, you have your death benefit that is not taxed. You have your healthcare benefits in your long-term care just the same, that is not taxed. And when you withdraw that money as a loan, or when you withdraw it for yourself, it is not taxed. Hey guys, one note that I want to make very clear, which was something that was interesting to me. Someone asked me a couple of months ago, said to me, Keith, let me ask you a question. When I drive my car, or when I go to take a loan out on my car, do I get taxed? And my response was, do you? So I wanted him to think about it a little bit, right? And he said, this is a 55-year-old man, by the way, okay, guys? But this is why the financial literacy, financial education is so important, why I choose to do what I do today and create this platform. The gentleman says, you know what? I'm ashamed to say I don't know. And I stopped him and I said, the first thing that you said is I don't know. The shame, no need. Most Americans, period, don't know. I've asked that question several times and people are confused. They don't know. I know on a loan, any loan whatsoever in this country, you do not pay tax. You pay interest, but you don't pay tax. So his response was, oh, okay. But you pay tax on what we call the gain, the capital, the car. Just like you will pay tax on the house, you pay tax on the car. Why am I going into that? It's because we need to understand tax now, tax later, and tax advantage. If we really break down taxation in this country, it is a lot of taxes that we pay. So any chance to avoid paying taxes legally is important. But how is that done? There's no way to avoid paying taxes. Let me just first say that since we're talking about it, there's no way to avoid paying taxes. But you can recoup the amount of taxes that you pay based on tax advantage vehicle that you would use to gain the interest that would offset the taxes that you've paid. Let me say that again. The way taxation works is that the gain of your interest that you're personally gaining can offset the amount of taxes that you pay so that you recoup those monies for yourself and your family. That is how taxes work. So let me ask you the question again. Where is your money? Is your money in a location where you're getting taxed now? I know several people who have over $250,000 in a checking account. I know people who do the same with their savings account. I know people who do the same with their CDs. Why? Because they're comfortable having their money in a bank. It's safe. It's safe. Hey guys, there's no safer place to have your money than in a financial institution. That financial institution that puts out that life insurance policy, for example, is the one who is insuring the bank. It's the ones who are insuring the federal government, the stocks, mutual funds, the bonds. That's the financial institution. That's why they are able to do tax advantage. They are the ones that are in charge of more growth, because your 401k, your 403b, for example, in the financial institutions will grow, whereas in the bank, 1% versus even 3% or 5%, 7 or 8%. Are you taking advantage of taxation? I want to leave you guys with that question. Are you taking advantage of taxation? That's a big question. Very unique one as well. So let me ask you a couple of more questions. One more question that I think is so relevant. Should you avoid paying taxes now? Should you avoid paying taxes later? Or should you avoid paying taxes, if you can, altogether? That's our show for this evening, or for today, that is. You're listening to Keith Simon, Keith Financial Fix, and this is Rudy Radio. Hey guys, don't forget to hit me up on Keith Financial Fix on Instagram. You can also email me at ksimonint@gmail.com. And I also don't mind having a phone call or two at 404-285-1429. That's 404-285-1429. Thank you so much, and we'll see you next time.